When the global bond market crashes and inflation rages, gold and silver are supposed to skyrocket instantly, right? Wrong. Historically, the exact opposite happens. In the first phase of a massive financial collapse, precious metals don't soar, they plunge alongside stocks. If you don't understand the hidden mechanics behind this liquidity trap, you will panic sell your assets right before the greatest wealth transfer in history. Here is why the current sell-off is a dangerous illusion. Look at the reality around us. The global bond market is in a state of utter turmoil. The United States national debt has relentlessly marched past $39 trillion. Inflation is back, hitting everyday families at the gas pump and the grocery store. By every traditional rule of economics, hard assets should be exploding right now. Instead, we just witnessed a brutal red week. Gold pulled back and silver plummeted, breaking down to retest critical technical support levels at $72.50 and $66. The mainstream financial media is already shouting that the precious metals bull market is dead. Retail investors are freezing up, paralyzed by decision fatigue and fear. But that is not the real story. In fact, this exact market anomaly has happened before every major monetary reset. Why do the world's ultimate safe havens get liquidated just when the financial storm hits? To find the answer, we have to look past the misleading headlines and expose the hidden plumbing of Wall Street. Because behind the panic, a massive trap is being sprung. To understand why gold and silver just took a hit, you have to look at the biggest whale in the financial ocean, the global bond market. Most retail investors stare at the stock market all day. They watch the Dow Jones, the S&P 500 or NASDAQ. But the bond market is massive. It is the bedrock of the entire global financial architecture. And right now, that bedrock is cracking. Lurtsit dang tunvut, bond prices are crashing. When government bonds crash, it sends a systemic shockwave through every bank, hedge fund, and pension fund in the Western world. At the same time, look at Wall Street equity valuations. The Shiller PE ratio for the S&P 500 recently slammed into 42. Let that sink in. A valuation of 42 is higher than it was right before the 2008 financial crash. It is dangerously close to the 44 peak seen in 1999, right before the dot-com bubble burst and wiped out 50% of the market's value. We are looking at an absolute historic bubble. Tech stocks are priced to absolute perfection. Debt is compounding at an unsustainable pace. The system is completely stretched thin. And this is where things get dangerous. When a bubble of this magnitude starts to leak, or when the bond market experiences utter turmoil, a chain reaction begins. The large financial institutions, the ones managing billions of dollars, suddenly start taking massive water on their balance sheets. Their tech stock portfolios slide, their bond portfolios bleed out. Suddenly, the red lights flash, the risk management algorithms kick in, and then come the dreaded words that strike absolute terror into the heart of any fund manager: margin calls. When a hedge fund or an investment bank faces a margin call, they don't have time to negotiate. They need cash, they need massive amounts of liquid capital, and they need it immediately to prevent total forced liquidation. But here's the catch. They can't sell their crashed bonds because nobody wants to buy them at a massive loss. They can't easily unwind their illiquid, highly leveraged tech positions without collapsing the stock price completely. So what do? They obey the oldest, most brutal rule on Wall Street. During a severe liquidity crunch, you don't sell what you want to sell, you sell what you can sell. And what can they sell instantly? What asset sits on their books with massive, unrealized profits? What asset can be converted into billions of dollars of cold, hard cash at the click of a button anywhere in the world? Gold and silver. This is the hidden plumbing of a liquidity trap. Gold and silver are the ultimate non-custodial, highly valuable premium collateral. Because they are highly liquid and highly valuable, they become the emergency ATM for a bleeding financial system. When the Western institutional complex panics, they dump their paper gold claims and physical silver allocations onto the open market, not because they lost faith in precious metals, not because the fundamental thesis changed. They do it strictly to survive. They burn the house furniture to keep the furnace running for one more day. This institutional dumping creates an artificial, aggressive spike in supply on the futures exchanges. And because the paper-to-physical ratio in the West is heavily skewed, some estimates putting it as high as 356 to 1, the paper selling completely overwhelms the market. The price on your screen drops. The charts show a brutal breakdown. The technical supports at $72.50 and $66 get violently tested. To the average retail investor sitting at home, it looks like a total disaster. You see the red candles, you feel the decision fatigue, you experience that creeping sensation of risk numbness. You start thinking, maybe the critics were right. Maybe precious metals are not a safe haven after all. But that is exactly what the elite players want you to think. They want you to panic. They need your physical metal to clear their paper liabilities. The mainstream narrative will tell you that gold and silver are falling because the economy is broken, or because higher bond yields make metals unattractive. They want you to look at the immediate price drop and miss the broader macro context.
Because behind the headlines, this sudden price drop is not a sign of weakness for hard assets. It is a mathematical symptom of a dying fiat system. It is the absolute proof that the Western financial system is so starved for real, tangible value that it has to cannibalize its own gold and silver reserves just to stay solvent. This is the liquidation phase. It is fast, it is violent, and it is designed to shake out weak hands. But this is where the doom and gloom narrative completely falls apart. If you are staring at those crashing red candles on your screen and feeling a sense of utter despair, you are missing the forest for the trees. You are falling victim to a carefully engineered illusion. Let us zoom out. Let us pull up the clean, long-term charts on TradingView and strip away the emotional noise. Look at silver. The mainstream media calls this a collapse, but the structural technical data tells a radically different story. What we are witnessing right now is not a death spiral. It is a textbook retest. Silver has just retraced perfectly to the apex of its multi-year wedge pattern. This is not a market breakdown. This is the final shakeout. It is the violent, necessary flushing of speculative leverage before the real move begins. And to survive this shakeout, you must understand a fundamental truth about macroeconomics: the relationship between the master and the servant. In the global financial theater, short-term price action is the servant. The high-frequency trading algorithms, the sudden paper derivative dumps on the COMEX, the desperate hedge fund liquidations, and the panic-induced margin calls, they are all servants to the immediate moment. They are incredibly loud, they are deeply erratic, they are highly volatile, but they are entirely temporary. The real master of this game is systemic inflation, the permanent, structural, and irreversible debasement of fiat currency. The servant might dictate the price of gold and silver for a day, a week, or even a month, but over the structural horizon, the servant always bows to the master. When a government runs trillion-dollar deficits every single year, when debt grows faster than GDP, the purchasing power of the dollar is mathematically guaranteed to die. You cannot stop it, you cannot fix it. And history has already given us the exact blueprint for how this plays out. Let us travel back to the great financial crisis of 2008. When Lehman Brothers imploded, a massive liquidity black hole opened up on Wall Street. Chaos erupted. Panic selling hit every single asset class. Did gold soar instantly? No. Gold plummeted nearly 30% in a matter of weeks. The servant, the margin call crisis, dragged the metal down as funds scrambled for survival. The retail crowd panicked. They sold their physical holdings at the absolute bottom, convinced the gold bull market was over. But then the master stepped into the room. The Federal Reserve realized the system was collapsing. To save the banking cartel, they introduced quantitative easing. They launched QE1. They spun up the printing presses and flooded the world with trillions of newly minted fiat dollars. And what did gold do? The moment the liquidity trap was bridged by printed money, the artificial supply of paper gold evaporated. Gold decoupled from the stock market and exploded. It skyrocketed from its liquidation lows, gaining over 180% to strike historic new highs. The hands that held firm through the shakeout inherited massive wealth. If you think 2008 was a one-time anomaly, think again. History replayed the exact same script in March of 2020. A global pandemic hit, the global supply chains locked up, the stock market suffered its fastest meltdown in history. Once again, the liquidity crunch struck. Margin calls forced institutions to dump everything. Gold violently dropped from $1,700 down to $1,450 in a flash crash. The media declared the safe haven trade dead yet again. Yet once more, the servant could only hold the line for so long. The Federal Reserve and global central banks had no choice. They stepped in with unprecedented, infinite monetary expansion. They printed trillions in a matter of months. The result? Gold didn't just recover, it surged to a brand new all-time high of over $2,000 an ounce just a few months later. And this is where things get critical for our current situation. The sell-off we are experiencing today, the breakdown toward those technical floors of $72.50 and $66, is a carbon copy of 2008 and 2020. It is the servant screaming in pain because the bond market is broken. It is a temporary liquidity spasm before the ultimate monetary intervention. The systemic debt is too high. The interest obligations are too massive. The central banks cannot allow deflation to clear the system without destroying the sovereign state itself. They will be forced to print. They always print. So ask yourself, when the final shakeout concludes and the printing presses turn back on to save the global bond market, who will you have surrendered your hard assets to? Because behind the headlines, the master is about to take control of the market once again. This brings us to the psychological battlefield where most retail investors lose the game. It's called risk numbness. When you stare at the flashing tickers day after day, watching the red numbers grind lower, your amygdala takes over. Your brain undergoes decision fatigue. You stop looking at structural realities and start reacting to short-term pain. The institutional elite understand this psychological vulnerability, and they exploit it flawlessly using paper silver. Right now, the paper-to-physical leverage ratio on the Western exchanges is operating at an astonishing 356 to 1. That means for every single ounce of physical silver sitting in a registered vault, there are 356 ounces of imaginary digital paper claims trading back and forth. It's a massive hollow illusion. Wall Street uses this artificial paper leverage to smash the price on your screen, completely blinding the retail crowd to what is happening in the physical world. Because while the paper price drops, the physical reality is heading toward an absolute breaking point. According to data from the Silver Institute, the global physical silver market is currently locked in a structural supply deficit for the fourth year consecutively. This isn't a minor imbalance, it's a severe systemic shortage driven by two unstoppable economic juggernauts: the artificial intelligence revolution and the global transition to green energy infrastructure.
Every single high-performance AI data center, every advanced electrical transformer, and every solar panel requires massive amounts of physical, industrial-grade silver. You cannot build the tech revolution on paper contracts. You need the actual atom. You need the metal. So while the paper servant drops the price, the physical master is running out of physical supply. And this is where the entire global financial system turns into a dangerous game of Jenga. Think of our economy as a massive Jenga tower. The bottom blocks are the structural foundations, real assets, energy, commodities, and physical infrastructure. The top blocks are the debt layers, corporate bonds, consumer credit, and the massive $39 trillion tower of U.S. sovereign debt. For years, the central banks have been pulling blocks from the bottom to stack them on the top. They have suppressed hard assets to sustain the illusion of paper wealth. But the tower is now incredibly top-heavy. It is swaying violently under the weight of surging interest rates. As the global bond market fractures, the Jenga tower begins to destabilize. Prominent macro watchers like Peter Schiff and Jim Rogers have issued a stark warning. The global central banking cartel has painted itself into a fatal corner. They are facing a brutal, binary choice. Option A, they keep interest rates high to fight inflation, which will inevitably crash the banking system, default on sovereign debt obligations, and trigger a deflationary depression that will completely destroy the Western economy. Or Option B, they choose survival. They pull the only emergency lever they have ever known. They capitulate, slash interest rates, restart the electronic printing presses, and aggressively monetize the debt. And let there be no mistake, they will always choose Option B. They will choose to save the banking system at the direct expense of the currency. They will sacrifice the purchasing power of the dollar to keep the government solvent. And this is where things get truly catastrophic. The moment the Federal Reserve officially capitulates and resumes massive monetary expansion to catch the falling bond market, the Jenga tower collapses. The floodgates of infinite fiat liquidity will open once again. But this time, the money won't flow into tech stock bubbles or speculative real estate. It will collide head-on with the physical world that is completely starved of real commodities. Tens of trillions of printed dollars will chase a severely depleted supply of physical gold, industrial copper, and structurally bankrupt silver reserves. Inflation will roar back, completely breaking past previous records and spiraling out of control. The psychological illusion of paper wealth will instantly shatter. And that is the exact moment when the great monetary reset begins. The paper leverage ratio of 356 to 1 will violently unwind. The entities holding those paper contracts will suddenly demand physical delivery of their metal, only to find the vaults completely empty. The price of physical gold and silver will undergo a historic parabolic decoupling. The servant will be completely obliterated, and the master will reclaim its throne. The red candles you see on your screen today are not a warning to sell. They are the final frantic signals of a top-heavy debt tower preparing for its inevitable collapse. At the end of the day, macroeconomics is not about emotion. It is about mathematics. The short-term price drops we are seeing right now do absolutely nothing to alter the fundamental math of sovereign debt. A red day or a green day on a digital screen cannot manufacture physical silver out of thin air. To survive this era, you must aggressively separate your emotions from your portfolio. Step away from the daily noise, stop looking at the market through the lens of panic, and start looking at it through the lens of history. Because when the smoke clears, hard assets will be the only standing pillars of real value. And this is where you have to make a definitive choice. Next week, when the futures exchanges open their doors, the volatility is going to get even more savage. The paper servant will strike again. The headlines will scream louder. When that moment arrives, what will you do? Will you panic? Will you surrender your physical hard assets to the highly coordinated smart money flowing into the Eastern central banks? Will you hand over your generational wealth just to clear someone else's paper liabilities? Or will you hold the line? Will you stand firm, grounded in history and mathematical certainty, knowing exactly how this movie ends? The crowd will freeze, the crowd will lose, but you don't have to be part of the crowd. If you want to stay ahead of the narrative, navigate this liquidity trap with absolute clarity and join a community of investors who look at the data instead of the drama. Hit the subscribe button right now. Let's build this long-term vision together. Before you go, leave a comment below. What is the exact price target where you are ready to back up the truck and accumulate more physical silver? Let me know your strategy. The system is shaking, the debt tower is swaying. Protect your purchasing power, stay rational, and I will see you in the next analysis.